Oil prices opened 6% lower today after the world's largest producers, both OPEC and non-OPEC, failed to reach an agreement over the weekend on capping output aimed at easing a global supply glut. The dropping crude prices today must be seen in the context of the 60% recovery that's been seen in the price of crude since the 11th of February. Wei Li, as head of investment strategy at iShares EMEA, joins us now. Give us exactly what's been going on here, because when we spoke on Friday about this, the expectation in the market seemed to be for a freeze, but they don't seem to have gone anywhere near that outcome.
No, they didn't agree on a production freeze, although market had been pricing in some sort of freeze, albeit loose agreement. And the reason for the lack of agreement has been specifically around Saudi insisting the participation of Iran, who wasn't at the discussion on Sunday. Given the fact that market had already priced in this potential agreement, it was a disappointment to start, which is why Asia opened down 6-7%, but since then has actually recovered, given some of the other drivers of oil prices stays reasonably intact. So if you think about the production cut on the back of some of the strikes in Kuwait, on the back of some of the outages problems in Nigeria, those are still in place. And if you think about the decrease in rig count and the inventory build slower than expected in the US, those are still in place as well, which is probably why markets seems to have looked through the lack of agreement and decided to focus on the other drivers.
So there's really potentially too much emphasis on this meeting. There's too much else going on, presumably.
There are many other things going on.
One other thing, of course, is the US shale output. Where do you see the emphasis going from this point here? Do you see that more US shale is going to drop out of the production? Do you see that demand's going to start increasing? Do you see any other dynamics that are going to overtake the overall supply glut that we've got?
Well, supply is a key factor when it comes to dictating where prices are going, and the race to price out the incremental producer in this global production competition is still very much on, which is why Saudi didn't want to lose market share by agreeing to any sort of production freeze. But at the same time, it is important to look at demand as well. When we talk about price, of course, it's supply versus demand. And we do see demand starting to slowly stabilize and pick up and work its way through supply too. So specifically, if you think about the China data that came out last Friday, that showed not only the consumption part of the economy doing well, but also the manufacturing part of the economy doing well. And that has a greater bearing on global oil prices, given that is really what the world is facing towards. And that improving is another evidence of the demand side improving, which could be further supportive of oil prices, which is why markets have not been solely focused on this particular meeting.
What about the ETF flow going into this meeting, the rise in oil prices? How has that dominated ETF flows, and what's been the outcome for the ETF market since this news over the weekend?
Well, it could be, although we don't see immediate flow data until one day later, that we could see some consolidation in terms of flows that have gone into energy exposure, specifically because a lot of flows have been going into such exposures in anticipation of a catalyst, a positive catalyst. And also, if you look at the CFTC future position building for Brent, it is close to all-time high. So given positioning is quite crowded, in the absence of a major positive catalyst, we could see some of those positions taking profit, especially because prices haven't actually fallen. So it is a good position to still recoup and lock in some of the gains. However, having said that, we continue to think, and we have seen, in fact, investors looking to play the longer theme. If you think about oil price at the current level, way below the incremental cost of production, there is a long-term value story that could be looked into in addition to the short-term speculative play, and we could see investors stay in it for the long haul as well. And one other form of investors expressing such view is going into emerging market assets, including equities and including debt. So year to date, emerging market equity within global ETP space is actually the equity category that has gained the most amount of inflow, more so than US equity and more so than European equities.
Okay, we'll get back to you some other time to see whether or not that continues, but thanks indeed there for joining us. Wei Li from iShares here, talking about where some of the value is in the markets.